Hi, Mark Anderson here, mortgage banker at Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. For today's mortgage rate update, I wanted to point out something kind of interesting, something to watch for. The fundamentals of this market right now as it relates to mortgage interest rates. Rates are fundamentally based on the performance of mortgage bonds, which is what I track in this video series. The bond market right now is not subject to what I would call normal market forces. The single dominant factor that's impacting the mortgage bond prices is the Federal Reserve's bond buying program. One thing to look out for, and I think this is very important, it may be a little bit difficult to track, so I'm going to do my best to cover it with this video series, is that if the Federal Reserve slows down or stops its bond buying program, that is going to be a bad thing as far as mortgage rates are concerned. Because if the Fed stops buying the amount of bonds that they're currently buying, or if they stop the program completely, they're going to be removing themselves as buyers from the bond market. And therefore, the remaining demand is going to have to be fulfilled by institutional investors, as would normally be the case. So today, there was something very interesting that happened that I wanted to use to highlight this. So this is today's bond price movement. You see we started the day here at a very nice price on this bond of 104.58. We actually had a very good morning. The bond prices shot up to this high level 104.69. Now right here you see a very big drop, and that was for a very, very specific reason. I'm going to switch over to a different view. So what we've got here, this is from the New York Fed. They published the results of the bond buying activity just today. And I'm going to zero in on two numbers here, total amount accepted and total amount submitted. What this translates into, the amount under submitted is the amount of sale orders that were placed. So these are bonds that were trying to find a buyer. And you can see that that's at about 13.7 billion. The amount that the Federal Reserve purchased is 2.5 billion. Okay? We're going to go back to real fundamental economics, supply and demand and price. Right now, we have way more sellers just today in the bond market than there was buy side activity. And what does that do to prices? It causes prices to drop. And so that is why we see this big drop off here. Because although the Fed is buying the bonds, they're not buying them meeting the seller side of the market. Therefore, prices are going to drop. So it's interesting to see that even in a fundamentally artificial market environment that's being propped up in the mortgage bond market with this Fed bond buying program, even in this artificial market, the fundamentals of economics still apply as it relates to price versus supply and demand. So this is something to watch for. If this becomes a pattern where the amount of sale, the amount of selling demand, is that a term? If the amount of people that want to sell in this market so far exceeds the buy side of the equation, that is going to naturally cause the bond prices to fall. Now, one thing that we do know is that as bond prices fall, interest rates do go up. Now, this could be a blip today. This could just be a back and forth. Maybe tomorrow it'll be very different. But if this trend continues, it will definitely lead to higher interest rates. Now, do I think that there is going to be a fundamental change in the landscape as far as rates are concerned? Do I think that we're all of a sudden going to see 4%? I don't think that if there is a change that it's going to happen that quickly. I think this is something that will be relatively slow and gradual. But if it continues, that definitely does point toward higher rates coming in the future. So just something to watch. I thought that it was so clear-cut today, this relationship, that I thought it would be worth pointing out in today's mortgage rate update. Overall, rates, I do want to make this very, very clear. Yesterday, the bond prices were at about 104.5. So on a net basis, we're not really seeing numbers that are fundamentally worse than they were yesterday. My rate sheets haven't moved at all. But again, if this trend continues, if we see this happen, it is going to cause these bond prices to fall over time, which will ultimately show up in higher mortgage interest rates. If you would like me to take a look at your mortgage scenario, whether it is a purchase or a refinance, or if you just have questions and you need somebody to give you a clear answer, please reach out. Call me, text me anytime at the number below. Please do like the video, subscribe to the channel, and hopefully I will be talking to you again soon. Thank you very much.